bringing on Eddie Austin today. So I'll give you a little bit of his background. Eddie is a serial entrepreneur, a visionary, and CEO of JE Capital. Eddie has numerous role models, mentors, and business experiences that have helped him understand the importance of recognizing profit opportunities in changing markets. He's developed a bold vision for a new type of real estate company, which will use changes in the multifamily real estate market and an innovative capital structure to drive profitability and aggressive growth. So without further ado, let me bring Eddie on. Hey, what's going on,
Hello,
Eddie?
everyone. Doing
Really
good,
great
man.
to
How
have
are
you.
you?
Thanks. Oh, I'm doing good. Thank you so much for coming on our show. We typically started off by just asking how you got started in real estate and then what you're up to today.
Sure, absolutely. So my start in real estate, was just like everybody else's, single family fix and flips. But I come from mostly the industrial world. And when you're making a lot of money in the fix and flip world, spending a bunch of time in there, and you're not really making any true wealth. Um, and when it comes to a point to where you need a lot of money and you don't have it because you're sticking it right back in the business model, it brought me to large multifamily. And how do we buy large multifamily? Through OPM with starting a real estate fund or syndication. So now today, I'm predominantly a real estate fund manager. I am a serial entrepreneur. I own 8 different companies. Me and my wife both do. And some of them are service business, but mostly we are excited and love doing real estate because the people we help and returns that we can create for others.
Very cool. Matt, you want to follow up with a question?
Yeah, I'm curious, Eddie. What was like the seminal moment that happened where you were like, multifamily is the way to go, or I got to go bigger?
Well, it's a great question. So, between our business opportunities plus real estate opportunities, we're making, $300,000-$400,000 a year, probably nothing to laugh at. But when it come time that a friend or a family member needed like $2,000 and I didn't have it, I thought this is sickening, to turn this much money and still not have $2,000. What if somebody needed $10,000? And because of a medical issue or something that would be very important for me to take care of. So at that point, with all that, the business venture that I was currently in and working a W-2 and still trying to flip real estate and everything else, I was taxed to death and I just never had enough money. It didn't matter how much I made. It just seemed like we never had enough. So from that, that brought me into, okay, we just got to go bigger, much bigger. We got to be able to buy bigger properties with more profits and just keep going that way. Because, just like I always say, syndication's like a hamster wheel. Well, I feel like single family fix and flips are the exact same thing.
Mm-hmm.
Oh, that's awesome.
So maybe,
Why didn't you do like, oh, I was flipping single family. I'm used to single family. Why didn't I just buy a bunch of single family houses, long-term buy and holds? Like, were you inspired by somebody that may have been, you may have been following, or was there like a conference you went to that got inspired you to go to the large, like multifamily route?
No. So, well, yes. So first and foremost, the single family fix and flip world, in my opinion, it's not a scalable business. I mean, yeah, you could probably scale it by creating systems and processes to where you would start a coaching program or something like that. And then you could sell that to other people and you could scale that exponentially. That might be one way to scale it. But as far as if you calculate the amount of time it takes you to fix, flip, and do that, you're limited by the people you have and your network. So to me, it wasn't a scalable business. But as far as a role model, through one of my companies, I was building a large sculpture for a guy that owned a motel. And 23-foot tall sculpture, stainless steel, pretty impressive. And I knew that the gentleman that owned this thing had owned a lot of real estate. And this is, right after 2008 through 10. And I had always asked the question, what was 2008 through 10 like for someone else? Because for us, it sucked. We were in the automotive industry and it was single family fix and flips, everything, we got rolled up. And from that, I asked him during one of our business meetings, I said, what was 2008 through 10 like for you? And he was the first person to answer the question. It's the best years they ever had. And I said, okay, well, do you mind explaining why it was the best years? Because I don't think many people can relate to that and answer it in that manifest, right? So he said, well, Eddie, I own a lot of real estate. I own the motel. I own motels around the country. And I own medical centers, stuff like that, big triple net leases. So at that time, he said, you know what, real estate's the answer, large real estate, commercial real estate. And I said, man, by all means, please give me the secret sauce to getting into that space. And what do you have to do? And he goes, Eddie, you're a smart man. You're an entrepreneur. Study the wealthy, success leaves clues, read financial books, and just dig in and you'll figure it out, because what I might teach you worked for me, but it may not work for you. So I think it was 7 years. That's all I did. And in 2019, we started our first real estate investment firm. In 2020, we started our first real estate fund as a 506c fund, $20 million in size for multifamily acquisitions.
Wow. That's a big
So
leap.
that was the path, man. That was how I got to here. And then, I've never stopped learning. I've never stopped educating. But I will say this, I'm going to do a video here soon on my YouTube channel, the worst years and best years I ever had. And it was due to education. So I feel like 2022 was the worst year for me and my wife. So I look back through my audiobooks and I only read one book that year. Previously, I read 5 to 8 books a year.
Yeah.
So there was a little bit difference there. The mindset was probably different.
So you start your fund, $20 million fund. What did that look like? Were you going in as a co-GP? Were you the GP?
No, we were going as, the fund was essentially buying the real estate. We might sign up a co-GP if we needed more of a sponsorship, if we needed for KP for say. But we were, owners, buyers, raising capital, closing the properties, doing the acquisition process, underwriting, the whole 9 yards.
Wow.
Now, that was me and my wife. So we worked our butts off to do that. And it was the middle of COVID, right? So with the cap rate compression and the fake pump of appreciation of properties, we essentially decided not to buy on many opportunities just because we knew that it wasn't the right timing. And I can honestly say I'm happy we didn't during that time, because now today you're seeing those properties, essentially going back.
Yeah. How are you structuring your debt?
So the debt we structure today, is a Fannie and Freddie product. But what we really look for is a loan assumption or a recapitalization opportunity. That's what we really strive to find. We're looking for a loan assumption that has a really good product that's already signed up. Maybe a sponsor got in trouble. Maybe it's a property that they just want to recycle their capital. And we can go in and capitalize on that low interest rate, but we can continue to own the property by putting our equity in place from our fund.
So cool. What are you working on today? Are you pencils down? Are you finding deals?
Well, it's a changing market. I know for sure you're seeing tons and tons of people that have slowed down in the buying process, and they're stepping up their educational platforms. They're stepping up other avenues of real estate. I've even noticed some guys that were previously buyers that are now wholesalers. They're finding opportunities in wholesaling. But for us, we're really just digging into, again, we went from buying, 2, 3 properties, let's see, 5 properties last year to, we'll probably buy 2 or 3 properties. So it's slowed down a little bit, but we're also looking at land entitlement, land development. We're also I found a real passion for helping other people. And I truly enjoy that more than anything else. It's exciting to buy a multifamily property, but for me, it's more exciting to teach someone new all the systems to go out and buy a property. And I'm happier for them than I am for me buying my own property. I know that sounds maybe different, but I don't know. It's just a passion for me to be able to take somebody new that's dreamed about real estate and physically getting them across the finish line with a fund, and then going and finding them an opportunity, and they buy that piece of property, and they're just, they're almost emotional to the point of tears. It gives you chills, right? So that's my true passion right now with this kind of a dead period of buying. I'm really focused hard on how can I help other people.
So, Eddie, what's your geographic area you look at in terms of properties in your footprint?
Sure. We're looking at North Carolina, South Carolina, Florida, and Texas, and all the strong MSAs in Florida. We're looking at Jacksonville. We're looking at Orlando, Tampa. In Texas is where we're really looking hard at. We've got opportunities down there. We're getting ready to close on 327 units in San Antonio next month. And then we got a 419 unit property that we're doing some value add on right now. We're probably 6 months, 8 months into the value add process, probably looking at a full year to 18 months to finish that. But then we've looked at 3 other properties similar in size. It's right in the Dallas market. So we're really honing in on the Dallas market for say.
So what are you seeing out there right now?
Well, I'm seeing a lot of scarcity in the market. I think it's going to be, we're getting ready to launch a $50 million fund. And I know I've had a lot of friends and other professionals in the space. They said, Eddie, are you sure that launching a $50 million fund is a good idea right now? It's going to be hard to raise capital. I'm the guy that signs up no matter how big the hill is, because we want to try and conquer that hill, right? So what I really feel like is now is the time. If you can raise capital in this season, you'll always be able to raise capital. There's investors losing money in deals. There's people that are just afraid of the market. There's people with banks crashing. They either lost money or pulled their money back. They're just probably sitting on the sidelines. And I would caution them against sitting on the sidelines. I've always told everybody, get your money out of stock, bonds, mutual funds, cryptocurrencies, anything digital, put it in a hard asset with debt on it, and good debt, not shady debt, not bridge loans, nothing like that. No hard money lending. Put it in a good agency debt or an institutional product.
Yeah, that's good advice.
So yeah, everybody on the street right now, everybody's sitting back on the sidelines, but I think at the other side of this, they're going to wish they didn't.
Now, are you raising for specific deals, or are you going to do kind of like an opportunity fund to capitalize on some of this distressed stuff that might come back to the marketplace?
So this fund here with Hampshire Capital is $50 million for multifamily acquisitions. 75% of that, 70 to 75% of that will be for multifamily acquisitions. We also put a land entitlement arm into this fund, and that other 25, 30% will be for finding land that has not been entitled yet. And we will buy that piece of land or put it under contract to be able to give that to a developer in the future to be able to develop a multifamily commercial building, something like that. So we're not going to probably buy distressed assets. It's all going to be for the same type of buy box that we've already bought, which is, a Class B middle market, a Class C value add acquisition, or a recapitalization on a Class A.
That's awesome.
So what's your typical model? I mean, if you're putting agency debt on the front end, do you execute the value add and then either refinance the debt stack or put on a supplemental loan? Can you give me some flavor on that?
Yeah. So, we're looking for long-term debt on day one. We're bringing our capital in. Right now, we're doing 35 to 40% down. So, a 65% LTV. And that long-term loan, we're looking for the best rate. I did talk with a loan broker the other day. A Fannie product was going to be about 5.1. The last deal we did, we were a blended interest rate of 2.95. So we're always looking for, again, that loan assumption. And that's an 8-year term, 2 years interest only. So the 2 years interest only really makes us be able to submit that business plan on the value add really easily because we're not paying, principal and interest.
Very cool.
So I can honestly say with today, there's always the talk about, is multifamily the best asset? And I get this question all the time. Yes, there's other opportunities out there, but I feel like, especially if somebody that likes to help others, people always will need a place to live. And, across the country, you could almost throw a dart at the United States and there's probably a housing shortage where that dart hit. So I still feel like multifamily is just a really safe bet.
Yeah, I agree 100%.
Mm-hmm.
So what's the future look like for you? What are you thinking for like the next few years, decade?
We're going to continue to buy properties, but at the same time, we're really going to ramp up this educational platform, because every time I've been at a real estate conference, I've been to 3 real estate conferences so far this year. Every real estate conference, they look at a person like myself. They look at, man, you're buying these size properties. Honestly, I want to create a program to where I could take every single person that I meet, I could put them through a program to where they could own or operate that property under our watch. And, essentially then we have, maybe 200 or 300 people that could operate 300 and 400 unit properties, even 500 unit properties right out of the gate, their very first property. Don't mess around with buying a 10 unit or a duplex or a 30, go straight to 300. And we can give you the systems and the backbone to do that. Now, ultimately, our fund would bring all the equity to the table. So they're not going to have to go out here and raise money as a new syndicator, a new fund manager. We're a seasoned professional. We're going to actually put our own equity up in place from our fund. And then my first company, JE Capital, we're probably getting ready to start a $100 million private equity fund. And that private equity fund will be for real estate related, but business buyouts. Probably 60% of that would be real estate ground up development, maybe a little bit of a distressed asset situation, but also gap funding. I hear so many people, they call me up and they're like, Eddie, you got $1 million. I got 2 weeks to close. There's a need for that.
Yeah.
I know I can tell you more than 10 times in the last year, somebody's called me up and said, man, we're 2 weeks from closing and I'm $1 million short on my capital raise. Oof. But
Right.
again, that's a problem with the syndication model.
What would those terms look like? Is it pretty expensive to get that gap financing from you?
I'm probably thinking we're going to be, 3 to 5%, with probably an acquisition fee or an origination fee on that, but by month to month.
Mm-hmm.
So I haven't hammered out all the details, but it's just an idea because I've got the phone calls. And again, I'm extremely passionate about helping others. So somebody has the phone call. Yes, I have a fund ready to go. I got money in it. How much you need? Let's look at the opportunity. And, maybe we can shave off some of the fees or the interest by becoming a GP in that deal. So I'm going to tell you, I've seen some really, really good opportunities that you never seen before because they were filling it with friends and family. It wasn't just blasted out on your social media platforms. I would have loved to have gotten that deal.
Yeah, that makes sense.
Good returns. One was a 10% cash on cash on a commercial property that was industrial space. Great opportunity. Needed $1 million.
Then how do you
Yeah,
find those people that are looking for the gap finance? Sorry.
What's that?
How are you going to find those people that are looking for the gap finance? You're just going to market for them specifically, or?
I don't even know that I'll
kind of-
market that much just because it seems like I've become very well known in the money space. I've always had a fund. So somebody thinks, hey, man, I need money or I need some capital raising done. Call Eddie Austin, see what he's got. Maybe he has money in his fund. Maybe he knows some people that can bring capital to the table. I'm connected to a lot of family offices. So, yeah, I have a lot of people that reach out to me for equity, essentially, whether that's capital raising or gap funding.
Nice.
Oh, that's awesome. I mean, yeah, I've been in the scenario where, I have a major investor that drops out when I'm raising money for a deal, and it's like down to the wire
Yeah.
after our money's hard, our earnest money's hard, and and it's always a scramble to
Yeah.
the finish line.
It's a terrible situation. It's a terrible feeling. It's your back's against the wall. You've already exhausted yourself with the capital raising up until this point. And now you sit here ready to go to the closing table within a week, 2 weeks, and you're freaking out. You're like, holy cow, where's my $1 million, and who's got it? And I think that's why I tried to really get in the space and really be known as the money guy, because I can guarantee you 90% of every person in a real estate meetup or a conference, they're looking for one thing: money. They might say, oh, I'm looking for deals. If they found a deal, they're going to need money next. So you're either looking for a deal or you're looking for money. There's either one of the two things.
Okay, so I have some IP for you.
Sure.
Eddie Money Guy.
Yeah.
It's yours, man, if you want it.
Yeah. It's a good one. I have started a hashtag on all my other platforms, investwithEddie.com or invest with Eddie Austin. And I've noticed that started to work, because if you type it in, my name comes up, one of my posts come up. But we're getting ready. I made a bet with my partner, steak dinner. So you guys are going to have to check me out, see if I actually had to pay for steak dinner or not. But we're going to raise this $50 million fund. He goes, okay, Eddie, how long do you think it's going to take us to raise $50 million? I said, 1 month. He goes, you're nuts. You're crazy. And I said, there's a steak dinner on the line. You're going to buy me a steak dinner, because I ain't buying you one.
And so then you'll tap into your existing database to raise that money.
Oh yeah.
You just start making calls. Yeah.
Yeah. What I do, I kind of do my funds like a syndication for cents. And I teach people how to do that as well. You've got a Facebook platform, a website. Start getting people excited ahead of time. Start telling them you're getting ready to launch this fund. Build that anticipation. And at the same time, you can start to build some scarcity, because spots will start running out pretty quick, especially if you're dealing with institutional or agency money, where people are actually writing, $10, $25 million checks. I know my $20 million fund, man, when my head hit the table, I was on LinkedIn doing a lot of networking. I had a family office reach out to me. We had about half-hour conversation. At the end of the conversation, they said, Eddie, we absolutely love everything about your fund. We've looked at your documents. It all looks good. We're prepared to wire you $50 million for your fund. And I said, whoa, wait a minute, guys. I can't facilitate more than 20 million. I can make some adjustments with my PPM and stuff, but I can only facilitate 20 million. I can't do it 50. And he said, unfortunately, Eddie, if we can't, this is our minimum. I said, well, what's your maximum? He goes, we wire 250 to 300 million. So just right there, if I had $100 million fund, they have the capacity to wire $100 million. My capital raising can be done 100%, one office. So
how do we
go ahead?
I was just gonna say, how does somebody go ahead? Sorry, Matt. Go ahead.
Mark and I are still trying to figure this out.
Yeah, I understand. It's kind of hard with 3 people.
So speaking of family offices, what is the general tenor out there amongst family offices in this environment? High interest rate environment, obviously, yield expectations are different. We're getting a lot of de-risking going on because interest rates are higher. Can you tell us about that?
Again, I know I've repeated myself a few times, but it comes down, it's the real truth. If you have a deal, finding the money's easy. And if you have a deal right now that is a loan assumption, so you're the family office, and I'm going to tell you the story real quick. So I'm going to give you my pitch deck verbally. I'm going to say, all right, guys, we found, a 400 unit property in Dallas, strong market. It's got strong demographics around it. Everything looks really good. We're planning to hold this thing for 5 years. We have an 8-year loan. It is a loan assumption. We are recapitalizing the debt because the bank is asking for the equity in play. We're going to bring this thing down to 65% LTV. We're going to operate this deal with a value add strategy, proven. This is our track record. This is what it's going to look like. This is the basis value. We bought it for $146,000 a door. Conservative underwriting in 5 years. We're going to sell it at $166 a door. Honestly, my true opinion, because of the market, demographics, and everything else, this thing will probably go for $200 a door. But I'm an under promise and I'm an over deliver company. So we got 2 years interest only, blended interest rate of 2.95. And I think most of the time that family office is going to say, where do I sign? Because you're sitting here, everything right now you've got is everything they're seeing come across their desk is higher interest rates. The underwriting's really conservative. It's really skewed, or they're underwriting way over conservative. They're just blasting out something that's not true, and they know that. And you can talk fluently and excited about your opportunity, and they're like, this is awesome. We've been waiting for a good deal. This is it. Tell you what, let us take a pref equity spot, or let's put all the capital into it. How much you need? And they might even be willing. And I usually ask the question, I'm constantly networking. So if that family office will only do $5 million, okay, that's great. I was really looking for 10. Are you associated with any other family offices or people in your network that would also be willing to do a $5 million check? Because we really need 10 million from family offices. You bet your butts they're tied to some other family office or know somebody in the industry. That's their game. That's what they know, right? So ask the questions. Be bold.
What about tips for people that are, more just getting started, they're on LinkedIn? Like, what have you found successful for finding these family offices and developing those relationships? What's your strategy there?
Tell people what you're doing. Tell people your returns on your deal. A few weeks ago, I posted on there, getting ready to start a $50 million fund. I didn't talk about the return metrics. I didn't talk about any of that. I just said, hey, we're starting a $50 million fund. I think there's probably 2 or 3 comments on there and messages where people message me wanting more information. These are people that's not in my network. So that means they seen that, it caught their interest, and they immediately messaged me and said, I would like more information. You do that on LinkedIn, Instagram, Facebook, Twitter, everything. And don't be afraid. I hear so many people, well, I don't raise money from Twitter because I never get any traction. You haven't yet. That doesn't mean you shouldn't post on there. You have to be consistent. You have to post often, and just tell people about what you're doing. Hey, I'm getting ready to buy a 500 unit deal in Jacksonville, Florida. Looking for investors, looking like great opportunities. Would you like more information? Drop a comment right here. Sometimes you don't even have to put a call to action. Just put it up there and somebody will comment on it. Mm-hmm. Keep sharing it. Put it on YouTube. Put it on your, do a webinar. But even before you engage in a webinar, I would use your social media platforms to just put it out there as much as you can. Then when you post, hey, we're going to have a webinar. Sorry, Mark. We're going to do a webinar next Tuesday at 3 p.m. Sign up here. So they've already known Eddie's starting a $50 million fund. He just talked about a 500 unit property. Returns look pretty good, but he hadn't told me anything about it. Now I'm going to attend this webinar. So, you've kind of elevated yourself up to that.
Okay. So you're not giving too many details in your initial post where you're just saying, hey, I started a fund. You're not, that's it. Like starting a fund, but then you'll have other comments sprinkled in later about properties that you're looking at and stuff like that, so they can build their own picture mentally.
Mm-hmm. Yeah. Because just like the success in YouTube, if you could tell absolutely everything about the thumbnail of a video, you're probably not going to watch it. You're going to watch the captions. You're not actually going to click on it. So if you put more curiosity and wanting to know more, most of the time they're going to jump in there. And again, on every webinar, every call that I do, I am always looking for a referral. So Mark, Matt, I know I've talked to you about my deal. You've said that this deal's not right for you. Do you know anyone, friends, family, anyone in your network? Have you heard of anybody on the street talk about they're looking for an investment? Great. Did you happen to grab their email? Because I'd love to speak to them. I'm looking to help people, and I'm looking to return a lot more returns than stock, bonds, and mutual funds, and it's a safe bet. So is there anybody in your network that I can help? And most of the time they're going to say, you know what? I got a brother just sold a business. I think he sold that thing for like $3 million. They really don't know what to do with the profits. I got a place, man. I'd love to talk to him. Can I? And then do it right away. Is there any way I can get on the phone with him today? Can you call him today? Adam can call him right now. And, patch me in. You got to do it right now. The longer you set, the more it's just going to fall to the wayside. Nothing wrote down, nothing done, nothing happens.
Very cool. You have any other tricks or tips for social media?
Oh man, I can't give all my stuff away. Oh no, the biggest thing is follow the greats. Look at Grant Cardone. And if you look at Grant Cardone, one of the best laughs I had on one of Grant Cardone's videos is they did that. Alex Hormozy, paid a bunch of money to get Grant on the phone and did that podcast or did that video together. And he's like, man, I don't understand why your social media platforms are so much bigger than mine. He's like, bro, go on social media. I'm looking at your social media right now. How many times did I post today? How many times did you post today? There's usually a difference. And YouTube, investing, everything is a long game. If you expect to win right now because you posted a video, you're going to be disappointed because it has to build up. Just like, you can't raise $50 million in a month without building a network, without, having some experience and getting beat up a little bit. It's just part of it.
Yeah.
I feel like there's a lot of things. There's something I just learned last week, and I don't know how I skipped over it, but I've been putting the blinders on a lot lately, building this $50 million fund, building the coaching program, looking at other business opportunities and everything else. I was more involved and more excited about the destination than I was in the doing. And that became a problem. I wasn't counting my small wins. I wasn't passionate about the process. I was 100% out of mind, out of body, just waiting to get to the finish line. And I can say that hurt me because when I would talk to people about opportunities to invest, opportunities with businesses and partnerships, they could tell I was hollow because I wasn't enjoying the process. I was just looking for the destination.
Right. Yeah. You got to enjoy the process. As far as like quantity on social media, there's a lot of gurus that say you don't want to overpost either. Are you saying that when you're posting a lot of stuff, you're doing it on different channels, or do you have no problem doing like 3-4 LinkedIn posts a day, or what's kind of your strategy on volume?
I don't, in my opinion, I don't think there's a such thing as overposting. You're going to find who your haters are when you overpost, which I like those too. Eventually they'll start cheering for you. And when a hater drops a comment, whoever's going to read that hate comment, oh my God, dude, you post too much. Somebody's reading that. Somebody's going to decide to subscribe or like to what you're doing because of that. So I don't think there's a such thing as posting too much. Now I have been throttled by the algorithm. So I've had Facebook throttle me before. They'll do that when my reels start taking off or something like that. Then I'll post a reel and it won't get any views for like 24 hours. I'm like, what in the world's going on here? And then, the next day I post a reel and it gets 1,000 views in 2 hours. And it's like, okay, well, something outside, what I can control happened there.
Yeah.
But again, I would rather let the platform figure out if I'm posting too much and not my followers.
Yeah, Eddie and Mark. I mean, my aha moment is like, Eddie. My background is I was doing more value add type of posts on all the platforms for years and years, just putting it out there in the ether with no sort of call to action or anything like that. a guy by the name of, I had a strategy call with a guy by the name of Joe Fairless back about 5 or 6
Yep.
years,
I know Joe.
ago. And he's about, establishing thought leadership platform.
Hmm.
And so, when I had my aha moment is I was walking on the canal with my wife and daughter, and I saw this guy that I hadn't even thought about, not even thought about of him in 10 years. Okay. And he was like, dude, I love what you're doing, man. Keep it up. So I had my aha moment was I was occupying mental real estate in this guy's mind for 10 years and I
Hmm.
hadn't even thought about him.
Yep.
Right. So, that's really where I was like, okay, I need to take this seriously. This actually does work in terms of having that circular reference to people in your sphere of influence that, if you think about real estate investing, you think about Matt Drew. And if you think about real estate investing, you think about Mark Up the Graph. All right.
Right.
Or Eddie Money, for instance.
Right.
So,
Yeah.
but yeah, no, I totally agree. I think the volume, the algorithm is only going to feed your stuff to people that are actually consuming it, because the algorithms are meant to keep eyeballs on the app, because that's how they drive ad revenue. So I think that if there's people that just aren't interested in what you're doing, they're not going to see it.
Right. Exactly.
Yeah.
With that, I can build on that a little bit more. So when I had first started my YouTube channel, I was doing kind of like motivational speaking, and it wasn't going anywhere. Well, I mean, if you get on YouTube, I mean, there's motivational stuff. You're basically, throwing you're throwing a minnow in an ocean. So to get discovered is just not going to happen very quickly, especially if you're not doing a lot of SEOs and stuff like that. So I come very close to a point of stopping YouTube because I thought, this ain't going nowhere. I was over at a buddy of mine's house. I had no idea, but he said, Eddie, you haven't posted. And I was in that season where I was thinking about quitting. And I was in that, nobody's watching it. He said, Eddie, I really wish you'd get back to posting some motivational stuff again. You don't know how much it helps me. And, unfortunately right now I'm getting ready to go through a divorce and it's really hard times. And you wouldn't believe how it picks me up just a few things. It's different because I know you and I know where you come from and I know where you are today. So it's motivating to me and it gets me up and gets moving. So he had never commented because he wanted to stay private. He had never really liked because he wanted to stay private. But you have to believe, even though your stuff is not getting, 50,000 views or not getting 30,000 likes, that doesn't mean people's not paying attention. Just like your guy that you inspired for 10 years, he probably never let you know on your platforms that he was watching, but he was. And then when he's seen you out in public, he's like, hey, I know that guy. It's just like Brandon Turner. I think he was on the Iced Coffee Hour. And he said, I launched one of my funds. And, when you launch a fund and we're raising money, it's all about when you know, like, and trust somebody, building that relationship, right? So he launched this fund and instantly people were calling him, hey, I've got money, and they've never asked him about his track record. Well, one of the people was going to be like a $5 million check writer. Mm-hmm. He goes, wait a minute. You've never asked me about my track record. You've never asked me about like the investment thesis, like none of this. Why are you willing to give me $5 million? And he said, Brandon, I've been listening to you for 5-6 years, man. Like I have a screen relationship with you. Like I've seen you talk. Your track record, you talk about it all the time, bigger pockets, So I think not many people realize that these podcasts and these platforms for seeing people talk, you're building screen rapport. You're building that know, like, and trust. Well, I know what Eddie's going to buy. I know what Matt's going to buy, and I know exactly what Mark's doing. So you kind of build that screen rapport with people and they get to know you through a screen.
Yeah. So powerful.
Well, I just keep telling people we got to show up. And, just like Matt, there's so many things like call to action. I feel like you almost have to have call to actions and stuff like that. If you just go through life like haphazardly, it's going to be a hazard, right? You're not going to get any expected outcomes because you're just bouncing around, so get directed. I would recommend writing your goals down. What is your goal for posting online? And then who's your audience? And then how is someone going to differentiate Matt and Mark to click on this podcast and other podcasts? What are you going to do that's different? And then you can kind of start to manifest, well, ours is different because, and I'm going to put a call to action like this because everybody needs to hear this. And then my crowd is that person that's really wanting to get in real estate or buying 100 unit properties, wants to buy 400 unit properties. Right.
That's right. I want to buy a 400 unit. I have noticed, honestly, that there's a lot of people in the capital raising space that are launching coaching things. And it just makes me wonder if they're not making enough money as capital raisers that they got to have this coaching stuff. So that's just
because
something I noticed. I'm like,
it's annoying.
go ahead.
Well, let me explain why it's annoying, because I'm gonna get harsh for a minute. I'm gonna be direct. So many of these coaching programs, they have 10, 15,000, 25,000 students. They're paying $40,000 or have paid $40,000 for a program they're going to get no physical value in. It's a transaction. And Mark, you know me, we've had dinner together. I'm not a transactional person. I don't give a shit about the transaction. I care about the relationship. So here we are starting a new coaching program against like Grant Cardone. Grant Cardone's always had one. Robert Kiyosaki, Ken McElroy, all these greats, Brad Summerall, Bridger Pennington. You got all these guys just ramping it up. They already have millions of followers. So then you've got this guy that's up here that just truly cares about the relationship and truly wants to help somebody. And I don't think you could buy everything in my cart and get to 40 grand. And even if you did, you're going to get some physical value. If you buy my program, you're going to physically have a fund in about a month to 2 months. So other programs, you're going to get an education. You're going to watch some modules and stuff like that. With me, I'm going to push you to actually crossing a finish line. You're going to have legal means to go raise money. So we're different than other coaching programs, in my opinion. But to your point, the buying season has slowed down. The interest rates are up. So they're high performing individuals. They're not going to just sit around. They're going to need a bunch of dry powder to go buy properties that go on discount. So they're ramping up the coaching programs. So they're bringing in everybody they can do. And here's my problem. They're thinking about the destination, not the helping the people along the way. Their destination is, I need a bunch of money. So when $229 million gets recalled at a foreclosure, I've got $229 million, just throw it out in cash.
Right.
So yeah, the guy that really cares about.
Actually, a question I had.
Go for it.
On the foreclosures, like when these big 400 plus unit things do get foreclosed, is that going to be a cash only transaction, or is there going to be an institutional investor that works something out with the lender so it doesn't go to foreclosure? What's your outlook on some of this stuff that's larger, that might be coming back to market because it's in financial straits?
So I know from what I do know, I believe the 229 million that got recalled, something funky about that. The bank actually credited it back to them. So that was kind of funky. That didn't really make sense. Another thing, because banks don't want to own properties. They don't. If it's not cash flowing, they don't have any business operating a property. But there's other ones that will probably put it out to institutions, say, for instance, BlackRock. BlackRock would probably display that to about 3 or 4 different institutions that they work that's under them and let them kind of put it in their books and do just a wire transfer or something like that to just bring in liquid and get rid of their asset. So there's not many opportunities for us.
Right. So it's kind of like a short sale for institutional buyers, right? There's something in distress. They're like, we'll buy it for a discount, and this is what we'll pay. And then it just gets transferred over to them, and the lender takes the loss.
Right.
And everybody else is wiped out.
Right. Essentially. The biggest problem is your investors are the ones that truly lose in that.
Oh, yeah. Right.
I mean, the bank's
Yeah,
they're not gonna be putting it on a 50C platform and making sure your distributions still go out to you.
right.
But one thing we can do is advertise the same thing. Let's go ahead and make a media post right now. If you have assets that are in trouble, if you know of property owners that are struggling, contact us. We have options for you. So you starting to
Yeah, that's true.
advertise, that would leverage that person, the owner, the sponsor that has that piece of property, to reach out to us ahead of time before the bank steps in, and we could start to work with them to fix that property. I know there's
Mhm.
1,400 units coming up in Texas as well, and we're looking at buying that entire portfolio, the whole 1,400 units. And that's going to take, a tremendous amount of time to do that. And another thing is they're not all the same loan. So there's different types of products that own that 1,500 units. So every one, we have to build a business plan for each buyout, because we can't just,
Mhm.
buy one out. There may be a loan assumption on one. The other one might have heavy penalties. So everything is different. It's a little bit different critique to be able to make that happen.
Oh yeah, for sure.
But, it's
Sounds very complicated.
well, it's
It's
fun for
doable, but
me. I love it. It's
yeah.
it's something that's hard, and I like things that's difficult.
Now, is that something you would use like a blind fund for
You could,
to take down?
blind funds are hard to raise in, and everybody uses the term blind fund. Your buy box should be displayed, your return metrics should be displayed, and you're going to tell these people what you're buying, how you're buying it. So it's not a blind fund anymore. You're putting all the verbiage right on the front of the building. This is what we're doing. But I've
What
noticed a
kind of
lot of,
structure
go ahead.
I was gonna say, what kind of structure would you use to buy this portfolio that's got various different lending structures and payouts and prepayment penalties, and how would you pull that off?
No, from shooting from the hip, I'd probably do a large sum. I would probably do a large dollar amount fund, probably a straight return, not a pref, probably not a waterfall, and maybe a 12% return to investors, just a straight line. And that's once
Mhm.
stabilized. It would be kind of hard to raise money in, but if you can do that, you could be a cash buyer, and you wouldn't be able to, you're not doing a capital call style fund. You're actually going to structure the fund, get the money into it. When you find that distressed opportunity, you can be an all cash buyer, the next in 2 weeks. You're going to do environmental study. You're going to run through inspections real fast. You're going to get some appraisals, maybe a few market studies, and then go buy the property, and then back it back up with debt and let the bank recapitalize your fund.
Mhm. Would it be hard to get investors into that type of structure where there is no waterfall?
Mm, I thought so, but I've got two other people that's in my network that are doing it, and I've made my immediate question was, "You got people investing in a straight return, no waterfall?" Yeah, they love it. Hmm.
Hmm.
Yeah, I mean, I was told, once a confused mind says no.
Yeah.
So when I'm, talking to high net worth individuals and maybe a physician, for instance, and once they start hearing about waterfalls and performance hurdles and all that stuff, it's like, eh, you're not expecting them to get a finance degree.
Right. Exactly.
So yeah, I
Exactly.
mean, I find that the simpler they could be, the deck being 5 pages, not 40 pages,
Mhm.
is very important. I have a follow-up question for you. There's this sort of philosophical debate about a fund versus a syndication. The syndication guys say that if you're a fund, then you got basically capital sitting on your balance sheet, and you feel the need to feed the beast. What do you
Mhm.
say to that objection?
I don't feel like they're utilizing the power of the fund. I mean, again, you can close with all cash of the fund. So I want money in my fund ready to go. Um, I want liquidity on my financial statement. When you go to close a property, there's two things a bank wants: net worth and liquidity. And then the third thing that usually comes up that usually nails everybody, and this is why syndication is really hard, is post-closing liquidity. What kind of liquid do you have after you close the property? So with a syndication, you have to build that in your model. If you have a fund and you're starting on your first property or second property, you're still going to have money, liquidity inside that fund, for expenses, for rainy days, stuff like that. You're still carrying money.
Yeah. The bank requires a little bit of that most of the time, right?
Oh, they do. Yeah. Usually, I just had this phone call with a broker with deals with Fannie and Freddie, and their interest rate was a 5.5 to 5.1. And on a $50 million fund, we're going to buy a $50 million property. We're going to put probably, $20 million down. And I said, okay, what is going to be needed today? And the reason I made this phone call was I know exactly what it took 6 months ago. So I said, what kind of restraints have been put on this? Because what I didn't want to do is launch a fund and not have the education on what the bank is going to expect. What do they want from me to check the boxes? So I called them up. I said, okay, what's the box sheet look like now? Oh, Eddie, it looks relatively the same. Okay, well, tell me what that looks like. So, well, we're still going to need 10% on post-closing liquidity. So if you're buying a $50 million asset, you're going to need $5 million in equity ready to go. Okay, makes sense. Plus your down payment. Okay, so I need to have, if I'm putting $20 million down, I need to have 25 allocated to this deal. You're going to need a track record. You've got that box checked. If not, you can sign up a property manager. Okay, great. And then what does the net worth look like? Well, if you're doing $50 million, we'd like it to be 1-to-1. So if you're buying a $50 million property, we'd like to know that you have, property is worth $50 million on your balance sheet for net worth. Okay, great. Anything else? Nope. I said, would you recommend buying a rate cap? Absolutely. Okay, we're going to buy a rate cap when we go to do this. And, you can even make money on rate caps. I just heard about a guy that he bought a rate cap in 2019 for 30 grand. And then he sold that same one in 2021 for $300,000. He made 270 grand on a rate cap.
Yeah, Mark, I was wishing I was doing that.
That was a thing.
Yeah, I got offered one when it was like on a deal where it was like 3.5% interest. And if I would have done that, I would have been able to make some decent dough on that right now.
Yeah, there's always ways to make money, even in selling a rate cap.
It's crazy. I'm definitely going to look that up after this. I didn't know that was a thing.
Yeah. Well, I didn't. Cool. I guess they're transferable, assumable, sellable, I guess you'd say. And I'm not a financial guru when it comes to the banking side of things, by no means. But that's just what my loan broker was telling me, and I was like, dude, that's amazing. And I know rate caps, just like insurance, have been probably 100% increase.
Right.
Yeah, and interchangeable term is an interest rate swap, right? Yep. Okay.
Yeah. Okay. Gotcha. Okay. Yeah. I have heard of those. Cool.
Yeah. Not something I want to be involved in. I like to close my deals.
Yeah.
But there's a lot of people, they went that bridge debt and they didn't buy a rate cap. And essentially today they can't close because that maturity is coming due to get out of that bridge product and go into a regular product, and they underwrote this thing at a 3.5% interest, and they're going to sign up for a 5.5% interest, and it really kills the cash flow.
Yeah, for sure. Cool. Well, we came up on 3 o'clock. I don't know if you got any other wisdom you want to drop on the audience while we got you.
Ask away, man.
Money.
Where to find money?
What do you think, Matt?
Last question.
No, I just said Mr. Money.
Eddie, so what's your fund offering structure from an SEC standpoint?
as far as, so we're a 506C, 3C5, so we're real estate option. And we're going to be about a 3 to 5 year hold. The harvest period's 1 year, but we're extremely active. So that harvest period is that period you're going to raise the money. Like I said, I got a steak dinner bet. We're going to raise it in 1 month. And then we're going to deploy that immediately. We're looking at properties right now. So we run our funds a lot like a syndication. So, we're looking at properties, and I've been telling the team, I was like, look, guys, we need properties. I'm not probably going to advertise the name of the property, but I'm going to advertise, what the metrics look like, what the property size is, that kind of stuff, the age, stuff like that, maybe a different town. And I'm going to advertise that property, just like a syndication. And then when our investors come in, this is the actual opportunity. They will have my pitch deck that will have all the correct verbiage on it.
Gotcha. Yeah.
So, and another thing
cool.
I would also add is, we just did a YouTube video on this, expected returns for 2023. I feel like investors are going to have to make adjustments for what returns are now. They're probably not 25% IRR. If you're looking at a traditional 506C fund, value add opportunity, you're buying, a mid 80s vintage property, you're not going to see a 25% IRR. If you are, I would really peer into the sponsor, and I would maybe even run, because I would say this. I think the higher the returns, the higher the probability you're going to call the SEC to want your money back. The lower the returns, probably the less risk, and you're not going to need to call up the SEC and say, I lost my money. So I think that expectations are going to have to change in the investment world. I do feel like that, the 16%, 18% IRRs are going to become the new norm, maybe in a 14. And probably that 3X multiple is probably gone, unless it's a very diversified fund to fund, maybe Neil Bawa, grow capitalist or grow capitalist, he might still achieve a 25% IRR, but you have to think how many properties he dumps in his fund, to get that up there. And he's owned these properties for a while. So right. When you see a 25% IRR, 3X multiple, 9% cash on cash, I would start asking questions. I would really look into those documents. I'd probably even call Mark and Matt up and say, would you care to look at this with me and make sure that this is okay? Because this seems unrealistic to the rest of the market.
Mm-hmm.
Yeah.
For sure.
How do you see build to rent stacking up, just as like a final build to rent? Because I know Neil is big on build to rent. You think that's driving some of the return he's seeing?
Oh, yeah. Yeah, for sure.
Yeah.
Mm-hmm.
How come more people aren't getting into the build to rent space? It seems like it's slow to gain traction.
I think everybody's stuck in the do what we've always done because it's worked. I think, just like we're working on other opportunities outside of multifamily. I won't discuss it now, but we're looking at opportunities in the private equity world that can bring 30% IRR returns, even 50% IRR returns. So I'm not going to sit here and just grind on my same education, doing the same thing, expecting a different result. This is a season to really peer into different opportunities and really look at it. Is there one thing I'm for here is creating returns and really good returns. So, if multifamily is no longer doing that, I'm the innovative guy that's going to go out and try and find something new that is a safe bet that we can be educated in and go ahead and go for the next opportunity.
Yeah. Well, now you piqued my curiosity. You got to let me know when you're ready to divulge these secrets.
Well, let's talk in the green room, Mark.
Yeah.
Yeah.
Yeah. We're still figuring out ourselves, but I think you just got to continue to think outside the box. Neil thought outside the box, build to rent, and he's winning in that space. So we just got to keep thinking about things.
Yeah. Awesome. Well, thank you so much for coming on the show. We really appreciate you dedicating some time for us.
Yes, absolutely.
And hopefully we hopefully we can get out and see you soon. I mean, I miss hanging out with you. That was really
I
fun.
know. You guys going to Fun Launch next month down in Miami?
I got nothing. I got nothing scheduled, but I'll
What are
definitely
you
take a look
doing?
at it if you want to shoot me the details.
What are you
I've
doing,
got
man?
so I've got to go to DC next week with my wife for conference, and then we're going to Italy in May. So that's
Mm,
going to be 2 weeks, and
yeah.
I haven't planned anything past that because when you're dealing with the wife, she's stressed. She wants to make sure every detail is covered. So
Hmm.
it's go time on that trip right now.
I can understand. I'll leave you alone. Yeah. What about
But
you,
I do
Matt?
need to go to Florida. So
Um, yeah, same here, man. I got my wife's got a bun in the oven. Our second that's going to be
Mhm.
due in September. We're trying to get as much. God, I haven't even made a post publicly about that yet. So sorry. Uh, but yeah, so we're just trying to enjoy as much as possible being, having an only child. So we're going to Disney this weekend, and then we're going to Italy in June actually. So we got a bunch of stuff going on, but I'm probably going to get more into the conference circuit. Mark and I are going to share a hotel room, and we're going to
that's
just
right.
we're going to paint the country, man.
You
That's
guys
good.
going to come to my conference in September?
Hey, I
Yeah,
I
possibly.
Yeah.
yeah,
So
possibly September
should be
is
middle of
down for us.
September. Extraordinary Capital Conference for our first
Nice.
one, and we'll see. We're still in the planning stages.
Yeah, that would be fun.
Yeah,
I'll get the boss's blessing, and I'll be there.
absolutely.
Yeah, and
Yeah.
Mark, I have a recommendation for Eddie when we go off the live.
Cool. Well, thanks to the audience. We'll click the end stream, and we'll see you guys here again next Thursday at two
Congratulations, Matt,
o'clock.
on the baby too.